Let's bring on Matthew Timpane, senior market strategist at Schaeffer's Investment Research. There he is. Matthew, good to see you again. We're talking small cap stocks. Is that correct?
Well, that is correct. Yeah, that's correct, Spencer.
Obviously, we're talking small cap conference. All right. What I meant to say was we're talking about the opportunity in small cap land, which is why you're here. So I'm going to bring your slides up on the screen right now and let you tell us about what you're seeing out there in the small cap area of the U.S. market.
All right, wonderful. Thanks, Spencer. As he said, I'm a senior market strategist over at Schaeffer's Investment Research, and we've been helping retail investors invest in options and producing trade ideas, research, free education on the options market, and news media on the options market too. That's a little bit different than a lot of places, but we also look at stocks and equities and the small cap spaces especially. So today we're going to look at if there's a potential for a rally ahead in the small cap space. So quickly we will look at the macro overview and some seasonality within the space, and then some companies to watch, some trade ideas, which everybody always kind of likes. So just quickly to kind of go over the Russell 2000 index, basically your small cap kind of indicator is, it's just been in this year-long consolidation phase, which is something we often see after large bull market year ones, which we had in 2020. And, this really is only applying to small caps this time, whereas we usually see it apply to stock indexes as a whole. You usually see it in the S&P 500 and the NASDAQ as well. But this year, it's really kind of just consolidated to the Russell 2000. But we've been kind of just sitting in this price channel here. Support has consistently been found around the 10% year-to-date mark, which is around the 210, 212 level. Resistance is around 232. As you can see, we were pushing the upper channel the other day. Now we have pulled back a little bit from there. This is kind of the 232 area is about 20% year-to-date level. As you can see, we failed there now 3 times roughly. This really could kind of be the time that we might finally get out of this. It's also kind of had diverging RSI throughout the year. The first thing that kind of popped out to me now is that we've now kind of broken out of that divergence. So we might be able to enter a new cycle here within this larger bull market that we started last year. In previous cycles, the 200-day and the 320-day moving averages have been like the deep pullback buy opportunities. It's kind of nicely been following that 200-day moving average right now. It's been holding. So even if, we've had the last 2 days now, today's down, yesterday was down a little bit. But if we keep kind of consolidating back towards that, lower 225, 224 area, you might get a good buying opportunity here in small caps for, kind of a run into year end. Obviously we want to continue to watch for inflation gauges here, because if inflation keeps beating expectations, that's something that's going to hit all stocks. But if we have controlled inflation, even with it rising, as long as it's supporting growth, small cap stocks could continue to do well as we move forward. So this is something I've shown, I think, at almost all previous small cap events this past year. Earlier in the year, I was saying, we're kind of approaching resistance here on a relative chart basis. And that's kind of exactly what happened after January, February's kind of run up in 2021. But where did we pull back to? We pulled back to a long-term kind of support area that we've seen hold, a couple times before back in the early 2000s, in an area that kind of where it hesitated before we fully got that flush out as we went into 2020, which obviously is a little bit different since it was the pandemic kind of crash. So we're in a good spot on a relative basis to be buying small caps here. If you've ever seen any of my previous presentations, I'm usually not the biggest fan of like trend lines and price channels within relative charts. I really more looking at horizontal trend lines, but this one was kind of just too obvious, too hard to ignore when looking at growth versus value. You saw this huge breakout of the price channel as we were kind of, soaring in 2020 and early 2021 in the small cap space, where you could basically throw a dart at the board and hit a 100% winner. Now we've pulled right back into that channel now as we had value kind of outperform here. in most of 2021. And now we're kind of back into the part where we can probably start looking at some growth ideas again. As the longer term, it's still going up. So we want to kind of have a little bit of a diversified portfolio, but growth is definitely back on the radar now within the small cap space. From a seasonality perspective, November has been great for small cap stocks. Last 10 years, November has been positive 100% of the time by an average of 5.1%. December has been positive 67% of the time by 60 bips. But over the past 20 years, December has been much better, with it being positive 68% of the time by an average of 1.3%. So we definitely have seasonality and the data supporting us going into November in the small cap space. Likewise, in the growth section of small caps, it's been positive 100% of the time in November. And oddly enough, 5.1% has been the average return in November as well. It's been positive 78% of the time in December by an average of 0.5%. So, and then also like IWM, it does get better in December. It does average on a 20-year basis a 1.1% return in December. Now, when we look at value, exactly the same kind of same statistics. It's positive 89% of the time, so not 100% of the time in November, but oddly enough, once again by an average of 5.1%. So the data kind of just a huge coincidence that it's kind of the same for all three, but it just seems like November doesn't discriminate. It likes small cap stocks, and value hasn't been performing that well in December. For small caps, but when you look back 20 years, it's actually the better performer, averaging about 1.5% in the 20-year basis. I wanted to just kind of throw up this fourth quarter by seasonality for sectors and industries. I've done it before at previous small cap events just recently. So I wanted to just kind of show you what sectors and industries really kind of outperform and just tell you quickly what ones stand out to me. Really, industrials stand out. They're one of the top performers. Financials really stand out as well, especially insurance and banks. As you can see, insurance is, I think, 2 of the top 6 sectors or industries within our seasonality gauge here. And then, consumer discretionary, and of course, tech still does well. Another one that really kind of stands out is alternative energy. Now, it's at the bottom of the chart if you look at it, but even though it's only positive about 42% of the time in Q4, it tends to boom when it is positive. And we've been seeing that lately with a lot of alternative energy stocks, whether it's solar or EV markets. We've been seeing these pull out of long-term kind of, intermediate downtrends and really kind of pop lately. We've gotten into a few Plug Power, SunPower, and I believe Bloom Energy is another one. So, we've had some nice returns on those trades, but we're really kind of seeing it outperform this Q4. So that's something that we like over at Schaeffer's from a contrarian standpoint. We're always kind of looking at that since we're kind of natural contrarians. Another area that we kind of want to look at is a sentiment basis in small caps, and there is like one little area of concern. Total short interest of Russell stocks. So what we do here is we actually aggregate all the stocks that are in the Russell index. We're not looking at IWM total short interest. We're looking at all the stocks total short interest, aggregate it to kind of tell us where we are with our short interest data. On a percentage basis over the past year, Russell stocks is in the 0 percentile. So that's always a little bit of a concern when looking at any kind of stocks, but when we look at it from the past 5 years, and this is kind of what still gives us hope, it's still in the 52nd percentile of total short interest readings. So that's much better than the S&P 500 and the NASDAQ. They're both sitting on their 1 year and their 5 year timeframes, anywhere from the 0 percentile range to the 5th percentile range. So a lot more short interest has been wiped out of larger cap and mid cap type of stocks versus small caps. So even though short interest is down 12% year to date, there is still opportunity here for short squeezes and unwinding total short interest among small cap stocks. We look at another indicator that's similar is the optional buy to open put call volume for small caps. It recently just kind of touched its highest reading since July 23rd. And then it's sitting currently right now at 0.275. And this is really the lowest level since late February 2021, where we kind of entered into that consolidation phase within the broader market. Now, it can get much lower. It can call bottoms and tops on huge spikes. But, the thing is this thing can continue to move lower to about 0.19. If we did break out, that's probably where I would start getting some concern that we might get at least a temporary pullback if we got a breakout from the broader index as well. So that's something to just be aware of when you're investing in small caps. This is something a little bit unique and different. I kind of just wanted to show it. It's relatively new to even us. We just kind of created it, a few months ago. I haven't got a good gauge on it necessarily myself just yet, but what we've created is what we call the meme index 10-day buy to open put call volume. We're putting stocks in here like AMC, Clover, GameStop, Mara, Palantir, SoFi, Virgin Galactica, Wish, Tilray, Workhorse, Robinhood. So we're really trying to gauge where the retail traders are placing their speculative bets within the options market. And it has called some kind of bottoms in the market, when you're looking at it from a contrarian standpoint. But oddly enough, sometimes it's you've had huge put spikes at the top too. So we don't have a real good gauge on it yet, but it's definitely something unique. And it is at its lowest since mid-January 2021. So that might be telling us something, but something definitely that we're going to continue to look at as we move forward. So looking at some relative charts within the small cap space where I think you might be able to get some outperformance versus larger cap components, we have small cap healthcare. It's kind of been holding this long-term trend line since 2014, and it's been outperforming large cap on the broader spectrum for quite a while now. But it's pulling right into a support zone that kind of was acting as resistance throughout 2018, 2019, even 2020, a little bit before it broke out of it. So you could be getting some opportunities in here. When I think about the healthcare space, I'm more leaning towards technology-based healthcare companies. So something like a Clover Health, a Change Health versus biotech. Biotech isn't my bread and butter. I'll be the first to admit that anyways, but that's kind of where I'm looking at, something that's helping with business services, patient services, to help patients out, and I believe that's where you're going to find the growth within the space. Small cap industrials versus large cap industrials has kind of been in a range for a while, but it did find its low point just recently. And you could look into the small cap industrial space. I do think there's plenty of room to the upside to outperform its larger cap peers, especially with the infrastructure bill on the horizon. It might lend its way into some of those smaller cap companies and help boost them. Then small cap tech versus large cap tech. As I said, not the biggest fan of trendline, but this one was kind of unique as well. Came through those two peaks, and now we're kind of just bouncing right around that area. So, or pulling into it. So, if we can hold above that small cap tech, we've kind of seen it kind of perk up a little bit lately. It could have another a go at it to go higher again versus this large cap components, which has kind of been pulling the market throughout the year along the way. So, we might have a little bit of a change in sentiment and a move over towards the small cap tech if we do get a breakout on that Russell index. Another area is small cap consumer discretionary versus large cap consumer discretionary. It's kind of at a do or die moment here. Small cap, if it bounces here, great opportunity to get in. If it does break down, though, below this support line, as it's seeming like it's trying to do, you'd want to stick more towards your larger cap consumer discretionary. It's something to kind of keep an eye on, though, if you're looking at any consumer discretionary stocks within the small cap space, just to see where you want to be and if you want to get in those stocks right now. So, some trade ideas. We have, I'll probably slaughter the name. It's Canaan Incorporated, CAN. Provides supercomputing solutions through proprietary high-performance ASICs. Basically, it's kind of a crypto and a China rebound play all in one. It is pulling back a little bit today towards, I believe, $8.50. I think even a further pullback to $8, $7.50 range could be due, but it might be a great opportunity to really get in. It's above almost all major moving daily averages right now. The only one ahead of it is the 200-day. It recently found support near year-to-date break even twice, kind of forming this double bottom down here, as you can see. And if this kind of breaks through that resistance band that I have placed above here and that 200-day moving average, this thing could really soar again. One concern is, it's basically all calls. Most small cap companies usually are all calls. Not too many people are playing puts on it. And peak call is sitting right at 10. So you need to understand it could be rejected right at 10 if you get in at, say, $8. It's still a nice, healthy return, but there's a chance that it gets rejected at $10. But if we get through 10 and we, subsequently get through that $11 area where the 200-day sits, we could be, full on massive squeeze mode in this company again. It's got 32,000 calls sitting at that $10 strike. So that market makers have sold. So then it would make them have to buy a bunch of shares to cover and hedge those sold to open calls ahead. So, you're kind of getting a potential here for a massive squeeze, and you even have some upside if we continue to see a little bit of a pullback here in the crypto space. Obviously, you want to follow the crypto market from a broad perspective as a whole because sentiment will flow over to CAN. So that's something just to be aware of. Eventbrite is another name that we like, provides a global platform for live experiences. Think about festivals and conferences. I don't know about you, but I'm excited to finally get back into some conferences, hopefully being live and doing some other things out there soon. So this is kind of a reopening play as well. It does have 64.2% expected revenue growth in the next 12 months. Short interest percentage of float is 12.1% with 16 days to cover. Short interest does appear to be wanting to roll over from all-time highs. And it's sitting right at about the 10% year-to-date level right now, just above that 200-day moving average. It broke out of its downtrend, kind of has this little mini kind of base with like kind of a handle, so like a mini cup and handle. But on the larger weekly scale, it's definitely a big cup and handle pattern. And, you're kind of breaking out of that flag. So, you definitely have, I think, upside here at a minimum to about the 22 area. Call heavy again, as like I said, most small caps are. But we are seeing some put activity. The 10-day buy to open put call volume ratio is now in the 82nd percentile. That could get the ball rolling on a rally. And then it's really no surprise that we're seeing this consolidation here and kind of stall a little bit. $20 is the peak call level, but we are sitting above it around $20.50, maybe a little bit lower today. But as long as it can kind of hold that $20 level, we are in squeeze potential currently. If this thing starts to rally hard, market makers will have to start buying shares to cover those calls that they sold to open. So really the only level that we need left to see be taken out to see this really take off is prior resistance, which just so happens to be the plus 20% year-to-date level that I have drawn there and the pre-pandemic kind of level. So if you make it through there, it's off the races potentially with this company, especially with good revenue growth and hopefully more reopening next year. Callera, again, maybe I slaughtered the name, but it's kind of, I would call it the Twilio of Europe possibly. Provides mobile communication services to financial institutions, e-commerce players, over-the-tops, software companies, logistic enablers. It's coming out of a long-term or intermediate-term downtrend. It's got short interest percentage of float of 6.74% with 7.36 days to cover. Short interest has been rolling over since June, so some shorts have actually made some, a little bit of money on it, but they are still covering this thing. It is call heavy again, but we are seeing put activity in this as well with the 10-day buy to open put call volume ratio in the 72nd percentile. If we can clear yesterday's highs, which peaked right out at the 20% year-to-date level, we have room up to $15. $15 is the peak call level. It's sitting there. If for some reason we did break through that level, we would likely kind of get that full potential, full-on gamma squeeze. But even up to $15, it's a solid return if this thing can hold these levels right below. This 320-day moving average that just newly formed has been holding beautifully throughout the volatility of summer and this fall. So it's something I would look to continue to hold if you want to be long this stock. This can actually be played through options too, as our equity VIX percent range, which is kind of our version of the IV percentile, is only in the 17th percentile. So options are fairly cheap right here. So you can play this through options as well. And then finally, we have Livent Corp, fully integrated lithium company, primarily produces lithium-based batteries, but also does polymers and other applications. Next 12-month revenue growth is 21.6% expected. And really, if you haven't heard of Livent, you probably haven't been trading small caps in the last few weeks. It's been a hot name. But short interest is up around 16% with 9.71 days to cover. Short interest is just hovering just below all-time highs and looking like it could roll over. It is kind of trying to find support here at these September highs from August, very similar to kind of what it was doing here late September, is finding support right at 20% year to date and these January highs. So as long as we can kind of hold this level here, continue to flag, let these moving averages catch up, you still have potential to move higher. Analysts are even fairly bearish on this. They do have 2 strong buys and 5 buys, but there's 8 holds and 1 sell rating. So there's still room for some upgrades for an outperformer. Like KLR, we can also play options as they are pretty much cheaply priced. They're priced in the 14th percentile. The one thing you do need to understand about this, though, is through November, you have the peak call sitting at $30. So that could really kind of cap the stock under 30 until those fall off on November 19th. That's it for me today.
All right. Matt, thank you so much. As always, Matthew Timpane is a senior market strategist at Schaeffer's Investment Research. Link on the screen. Matthew, a pleasure. I think if we take away one thing from this, it was from the beginning when Matt said seasonality for November, looking good.
Yeah.
Small cap.
Yes, it is.
Thanks a lot, Matthew.